Good morning. It is March 8th, 2019, and everybody was screaming this morning about it's the end of the world again. Every time they tell me it's the end of the world, I wonder, how do we keep getting back here? So let's go over the jobs reports. Let's talk about some things that could happen here. But let's get into some investment ideas that I think are going to be very important over the next several years. So the first thing is that hiring slowed down in February, and the headline in the Wall Street Journal is that employers struggled to find workers. For the past year or more, I have been talking about how there is a skills mismatch. This is not big news, it's not exciting new news, but a year or two ago when people like me were talking about it, it wasn't widely believed that there was a skills mismatch. But it's becoming more and more important that there is, as there is about 6 to 7 million open jobs in America, but there's also between 6 to 7 million people who are unemployed. So why wouldn't those 6 or 7 million people fill the 6 or 7 million jobs? And it's a combination of two things. There are certain jobs that people just won't take because they feel like it's below them, or they don't like it, or the money's not good enough, whatever the case. But most of it is a skills mismatch because a lot of the jobs are in healthcare and in engineering. And by engineering, it doesn't mean that you're expected to build a bridge, but you have to have some level of engineering abilities, whether it's at the building level or in a construction capacity or different types. There's also a lot of technology style type engineering jobs out there, so technology related, but we really have a skills and education problem in a part of the economy that for a very long time we've had a problem with, and now it's coming home to roost. So over the next several years, we should expect employment to be trending higher and unemployment to stay relatively low. The numbers that we get now indicate that, okay, there's a breather going on. How long will that breather last? A year or two? I don't know, but it doesn't seem like the world economy is crashing. There's a little bit slower growth. We've been talking about that with the slow growth forever economy concept and thesis for the better part of a decade now. We've known this was coming, but people still want to live in yesterday land. And the idea is that 3 and 4% GDP growth are what we should be looking for. It's just generally not right. Now, back in 2011, 12, 13, I did project that we'd have very high growth in the United States at the end of the decade, 2018, 19, 20. And the reason I said that is because I knew, and you can Google freedom from OPEC, my articles, 2, 3, or 4 of them will pop up. And I knew that as we got to be free from needing OPEC, which is about where we are right now, by the end of this year, OPEC will be very low on our radar. We just simply aren't going to need them very much. And that's because all the oil that we need is coming from this hemisphere now. And as Exxon and Hess and Chevron ramp up projects around Guyana and Brazil, and hopefully someday Canada gets that one last pipeline they need into the United States, we simply don't need the medium crude and the heavy sour crude, but mainly the medium crude from the Middle East. So with IMO 2020 starting next year, which is the cleaner fuels needed for shipping, light sweet crude will find another demand driver. And you're seeing refineries start to adjust the best they can. You know, they try to do it on the cheap because they know that we're at the beginning of the end of the oil age. So they have to weigh their spending on revamping refineries versus how long they think they're going to need these refineries. Now, for the most part, we're going to need refineries for a very long time, 20, 30 years for sure. And as some of these refineries retire, it'll probably coincide with the demand for oil turning over and dropping. But even by 2050, I still see us needing 50, 60 million barrels of oil per day. I've put that chart up. So I have projected out that we peak in oil demand around 110 million barrels a day in the next decade. Maybe 105, maybe 115, but in that range. And then it turns over after 2030, because sometime in the late 2020s, pushing 2030, electric vehicles will start to outsell internal combustion vehicles, particularly because they're becoming illegal in some places. So internal combustion engine cars probably get this huge surge of buying in the next several years as people start to realize the laws are changing and a lot of things are changing. So a guy like me, I might go out and buy that sports car, or I might go out and buy a last gasoline powered truck. Why? Because I probably can afford it. So, I'm in that 10% of the population that can have 3 cars, but also because they'll become collector's items. So I'm actually looking at buying older sports cars, but there's going to be this last surge of ICE vehicles, and then it's going to turn over. And once there's more electric vehicles being sold than ICE vehicles, now it becomes a question of how long it takes to retire those vehicles and get them out of the circulation. If I'm right, the supply of oil will start to exceed the demand for oil 4, 5, 6 years from now, 7 years from now. How will that happen? The first thing that will happen is you're going to see all of the offshore drilling around Brazil and Guyana. So you get that one last surge as Exxon and Chevron try to save themselves. Why am I talking so much about this? Because we know that we are at the end of the beginning of the end of the oil age. So these are very important concepts when it comes to economic growth. Why? Because energy has always influenced economic growth. Those who borrow their energy or buy their energy are usually those who have constraints. Well, I'm trying to get people to understand that the United States is in a remarkably good position globally. I know everybody runs around and wants to talk about, oh my God, hiring is down, growth slowed, things like that. The next crisis is coming, bubble this, bubble that. But the reality is that there's a solution for every problem. Usually those solutions come pretty quick. Could you have a 2008 style event? Yes, and we probably will in the next decade or two because of the impending massive boomer retirements that are coming. But when you strip out the gloom and doom and you say, okay, what really impacts the economy, you're taking a look at energy, technology, strength of the workforce. So we need our workforce to get better. It's pretty good, but we need it to get better. So when we hear ideas about guaranteed employment, gee whiz, if you have the right training right now, you have guaranteed employment pretty much, because there's a ton of jobs available, and the boomers are gradually retiring, and it's a large group of people to be retiring. So filling those slots, even if we only need to fill 4 of every 5 spots that disappear, right? Because of automation and machine learning, maybe we only have to fill 4 out of 5 spots that become open. The point is that we are seeing the numbers right now. Employment is high, unemployment is low, and that's going to continue probably for the next better part of a decade, any recession or crisis that comes along. And, those come along because of trends in investment, because of trends in consumption, because of overbuilding. One of the places where there's probably overbuilding is in apartment complexes. I'm seeing rents come down in certain parts of Milwaukee. They've peaked in the last year or so. And I know that that's going on around the rest of the country. So there will be some retracement in rents. And some of the REITs will probably not do as well in the next year or two as they've done in the past. But you have people who are in love with investing in REITs, so they'll buy every dip, right? Maybe the dips get a little bigger and they freeze in the headlights for a moment. But there's a certain assets to catch a bid, and real estate's one of them. So when we really want to think about all these interconnected moving parts, energy, technology, real estate, these are all very important factors, and it becomes difficult for us to wrap our heads around it, and we just get, you know, inundated with all this information and the movements in the stock prices. So everybody's like, oh, the stock market's down 2.5% at the start of the day today, right? Well, what's it down right now? And everybody was breathy this morning on TV. Stock market's made a massive comeback. You know, let's take a look at just, I don't know if I can do a one-day chart here. One-day chart. You know, market fell off, bottomed out pretty early, and look where it came from. 272 at the low. Oh, that's not even right. Yeah, gap down here, the start of the day, and now it's working its way back. So this was the breathy, oh, there's something wrong with China, the employment numbers look funny, market drops, and then it starts coming back. These gaps usually mean that there's just a lot of emotionality in the market. And when we take a look at the money flows, I head up, when we take a look at the money flows, this looks like it's a problem, right? It's turning over. And for a trader, this would be a problem. If you're an investor, it's a different story. Take a look at the weekly charts. That's pretty constructive, and not nearly as high as it can get. So in the very short term, and we're talking days, maybe a week or two, you get these turnovers, you know, and the turtle traders and other traders would look at 4-week periods. So could we get another week or two of correction? Sure, you always can get another week or two of correction. But this is pretty constructive. Money coming into the markets. So that's what we have to keep an eye on, is where are the big pieces of money? And we need to wrap our head around the fact that we're not that important. As far as retail investors go, we're not that important to the market. We're not anywhere near as big as the institutions, and you can break the institutions down to all different things. You know, pensions, which are in net outflow, probably forever now, you know, with little pauses in the first quarters. And the hedge funds, which sold off big in the fourth quarter last year, they're accumulating right now. And there's no tax loss selling right now. So we take a look at these money flows and we can see this is it. So let's take a look at a longer period. We're not really to any overbought levels. There's an awful lot that this can drift up. And I would anticipate that throughout this year, we should be buying the dips because there isn't any particular crisis that's on the horizon. Next year, however, there's a psychology issue. So next year at some point, if it looks like President Trump is going to lose, and I think that this is probably likely, then we are going to see selling by very wealthy people who are afraid of losing their tax breaks. So next year, that's something to keep an eye on. If it looks like the Democrats are going to take the presidency and more seats in Congress, people will have fear of losing their lower tax rates for this year and last year. And they'll sell next year at some point. We should keep an eye on that. If it looks like President Trump is going to win and the Republicans are going to hold, you know, at least half of the Congress, then maybe we don't get that tax loss selling next year, or tax fear selling next year. Maybe we get it the year after when the economy finally slows down a bit. Who knows? So we have to just keep an eye on these things in real time, and we have to realize, hey, really as investors, we're just looking for really good companies. So let's look at a real good company. Yesterday, and the day before, I started talking about China again. I mentioned China again this week. because the rally in China looked like it got a little overdone. Now all of a sudden we get this pullback in China because they do manage their economy quite a bit and their markets quite a bit, which is why socialism's a problem, is when you get governments this involved, things get out of hand in both directions. So the government started to stimulate, and the market ran way up. And then the government told one of the brokerages, hey, put out a warning, and the market went way down. Do you really want your markets impacted that way? No. China does it that way, and they boom and they bust in their market. And then we find out that their growth pace was inflated for 9 years. Hey, who would have ever guessed that China was lying to us about the growth numbers? I've been talking about not trusting China for years. So, all these moving parts. But within this gigantic economy in China, what do we have? We have a really impressive technology sector developing. One of the analysts that I have access to, and one of the criticisms I got recently was that I'm a one-man shop. Kinda. I have access to a ton of research, and I've hired analysts, and I'm now part of a 10-analyst group, some of the top analysts in the country. So, one-man shop, yeah, we're all one-man shops or one-woman shops. But the reality is that it comes down to access and then the ability to process and have some experience with this sort of thing. We're not looking at a crisis. We're looking for good investments within a changing world. And the world's changing. And what's one of the biggest changes? How the energy system works and how technology impacts everything. I've been coming more back to real estate lately because, we're not making more of it. And in fact, with rising ocean levels, we're going to have less of it. So those are long-term trends that we have to find a place to put our money in. And, you take a look at China, and KWeb is a fund that we've talked about a number of times. You take a look at this 3-year chart, big run-up, big collapse. And I know some people who invested in here. We talked about it in here. I didn't issue a buy alert because you like to see it come off first. Well, it came up so fast that we missed this 30% move. Well, now it's hitting resistance at 200-day and that warning. And I would think that if we can get this down 43-ish, you probably want to finally start building your KWeb position a little bit. Why? Take a look at the holdings. These are some of the most impressive companies in technology in China. But you really do need to stay out of the middle of the market and buy when there's a good correction. Here's a company that we talked about specifically in all of the investment groups now. Alibaba. What's going on with Alibaba that's so impressive? Well, you might think of them as basically being like Amazon, and that would be good because they are like Amazon in 2 ways. They're not just selling things over the internet. They are building a massive, massive cloud infrastructure to not only support their business, but support the businesses of other enterprises. So with Amazon, in 2006, they introduced Amazon Web Services to support their peak days. They built it because they had such a handful of busy days during the year that it would crash their servers. So they built out this infrastructure, and they're like, well, we need this infrastructure several days a year. What do we do with it the rest of the year? And they started selling cloud space and online services, infrastructure as a service to the rest of the world. And now Amazon's revenue is 58% web services, right? Amazon Web Services, the cloud support. Alibaba is building the exact same model. They're nearly a decade behind us. The market for cloud services is growing at something like 25% a year right now in China. And in fact, it's growing that fast here. So it's probably growing faster in China. Hard to know, right? Because we just saw that they lie about their numbers. But Amazon grew from whatever it was, a couple $100 a share to $1,600 a share today. In the last decade, what you've taken making 8 times your money. I don't know that Alibaba will do that. It's not the cheapest stock right now, right? But when you take a look, you say, okay, over the last 3 years, it's been chopping around in here, and it broke down here. That's a double bottom, and now it's correcting again. It gets into those 160s, I think it becomes an incredibly attractive stock. Gets into all these support levels. Now, could it triple bottom? Sure. Could it get all the way down to 140, 135 again? Absolutely. So you keep some of your powder dry. But when you think about the growth that Amazon showed over the last decade or so, you should really consider that Alibaba might be about to go on the same sort of path. So if you had wanted to buy Amazon, and let's just compare, take a look at Amazon on the same chart. 10 years, right? Introduction of Amazon Web Services, right? We've talked about how companies just chop along for a long time, better part of a decade. Amazon Web Services in here, and look at that. Just adding and adding and adding, because the cloud is growing super fast. And it's going to grow super fast for the better part of a decade because of this whole smart everything world that we keep talking about. Take this blue line, throw it over here somewhere. Now, will Alibaba necessarily do this? I don't know, but I think it's going to definitely curve up. So what if it gets to $600, $700, $800 in the next 4, 5, 6 years? I think that's reasonable to think that it might, because they are going to be increasing their revenue by double digits every year for many years. They're probably, and some of you know one of the technology analysts that I've been bringing in as a kind of a guest, and I talk to her here and there and read her stuff. She has something here. If you haven't gone to best.technology, you should. This is her free stuff. I get access to her, paid stuff. Some of the best tech stacks for secular infrastructure as a service, cloud. Just think of it as cloud. You take a look at this, and you're like, okay, well, Amazon is still a core holding because they probably double or triple still yet in the next decade. But where can we find this type of growth way earlier in the cycle? And it's Alibaba. Why? Because the cloud space in China is only about $3 billion right now. It's $40 billion in the United States, growing to 80 in the next 3 or so years, according to Bain and Goldman Sachs and everybody else who does those estimates. If you're growing 25–30% off of a $3 billion base, and you need to grow your cloud services to be about the same size as the United States, just extrapolate those numbers. From $3 billion to over $100 billion in the next decade, those are big numbers. Alibaba is the leader in that space in China, and they're probably one worth owning. If you don't want to own Alibaba as a stock, buy the basket, which is K-Web. And where do you buy it? In here, a few more dollars down. I could see Monday being a bit of a blow off, but when this gets down here, when it gets oversold down around 30, anytime it gets down to around 30, you generally get a bounce. With China stimulating and managing their economy, I just don't see any massive collapse. And I know that there's people out there that run around saying debt, debt, debt. Debt is an easy solution, an easy problem to solve. I'm not a right-wing guy, but Dick Cheney said a long time ago, debt doesn't matter. And now you have all these modern monetary theorists out there saying, debt doesn't really matter. And why doesn't it really matter? Because at the sovereign level, if you have a currency, that's important, that's tradable, international, that you can print and take on the debt yourself, or do helicopter money, which I've talked about. that becomes less of an issue. So if we just put 20, 30, 40 trillion dollars into the retirement system, and I'm going to write an article about this and send it off to various people, the money trickles into the economy as an offset, an inflationary offset against all the deflationary issues from demographics. So we shouldn't be that afraid. Every problem out there has a solution. It might take a year or two to find it, right? You know, Winston Churchill, the Americans do everything right after they try everything else. You know, we can count on the Americans to do things right after they try everything else. You know, I think that's going to be true forever. So when this pulls back, we need to use a longer chart. You know, when this pulls back enough, man, we're getting closer already. And these corrections are pretty important. So, you know, we will see. Somebody sent a message regarding we don't have enough workers. We have plenty of workers. They're just not trained. And with machine learning and AI, there's going to be a lot of jobs that just don't exist in 10 years. You know, there's actually somebody who's been pointing out the guy that's running for president. I think his name's Yang. You know, hey, investor of the future, tell me his name again. Is it Andrew Yang, maybe? He's running on the universal basic income platform. We're not anywhere close to needing that. Let's fix healthcare first. But, you know, maybe in 20 or 30 or 40 years, you know, there's going to be so many machines out there doing jobs for us that we have to figure out a way to make sure everybody has a good standard of living and that like 12 people don't have all the money. So, you know, that's for down the road, but it's a good thing to talk about and start thinking about. In any case, I like Alibaba. I think it needs to come down a little bit more. But I did take a little starter position, but down around 160. I think I like Alibaba quite a bit. And then if it got down to this level again, that would be kind of your back up the truck thing, back up the truck price. Last year, when I put out these watch lists, right? And people ask me, well, these bottom fishing prices are so low, right? Last year, these bottom fishing prices are so low. And now all of a sudden, we have a lot of companies down near those bottom fishing prices, which are huge support levels, and they can be broken, but generally those huge support levels hold, right? The huge support levels are prices like down in here. And at the start of 2018, people are like, well, there's nothing near your bottom fishing prices. So people would buy. Well, it's going up, so I'm going to buy it. And then we got the correction in February, which we were actually very prepared for. The volatility event we were very prepared for. You know, we actually had money invested in the volatility calls and in the S&P 500 puts. And we did have people that made tremendous amounts of money on that. Going into the fourth quarter, prices were, you know, nobody was near their bottom fishing prices again. And I anticipated the pullback in the fourth quarter. I did not anticipate the magnitude. The sell-off in December was way more than I expected. The way oil came down and is still trending because of the divestiture movement that we'll get into in a second again, was more than I expected. So I get criticism because I missed a trade. You know, that's life. Nobody's going to get every trade right, but you have to go back and try to understand it. Well, one of the ways to protect yourself is stay away from the middle of these markets. Wait for bottom fishing prices to come in. And I'm not a huge fan of HP, but they kick out a dividend, you know, and they don't really have much downside risk. And if they ever do anything right again, yeah, maybe the stock goes to 30 or 40, right? So when you get a dividend, if you're a dividend growth investor, companies like this with low risk, near their bottom fishing prices are pretty attractive. One that we've gotten our tail kicked on is Centurylink, right? You know, I put in a bottom fishing price of 16 and it's down at 12, 17. Been buying it throughout the teens, 16, 17, 18, 19, been buying it. So we're down 30% on this stock. Does that mean that I should sell it? No, it means that I have to evaluate, okay, was this wrong or is this overkill? I think that it's overkill. Why? And I'm talking about Centurylink because somebody asked about it. Centurylink has an asset that simply is irreplaceable. They have the second biggest fiber optic network in the country and third or fourth in the world. It's huge, 120 countries or something. So they have two massive businesses. Their enterprise business, which is what they're trying to grow, and they're doing a good job at that. Then they have their infrastructure business, which can apply to 5G applications. Then they have their consumer business, which is what everybody pays attention to. Their consumer business will be repaired the same way that AT&T is repairing there and Verizon is repairing theirs. Different strategies, all three companies, but they have the ability to increase their revenues simply by raising the price of internet service. Why can they do it? Because they are in part of oligopolies wherever they are. There's not a lot of competition. And just because they lose their cable TV revenue, say at AT&T, or CenturyLink provides, different services, they can just raise it somewhere else. So it's a shifting of money. What do we know about transition? Transition yields a lot of volatility and a lot of opportunity, and you just have to put it on your side. So, with CenturyLink, if you don't own it, I'd say you ought to be nibbling in because these guys have something that can't be replaced, and they are clearly a takeover target at this point from companies like Google, who may want to have an international fiber network. Google. Will Google be interested in fiber? Google Fiber. Oh, wait, they have a division called Google Fiber. So I don't know that Google's going to go buy them, but at $13 billion market cap, I mean, that's pocket change for them. So these bottom fishing prices is what I think you need to pay more attention to as the world over the next several years is more volatile. And I have about 20 growth stocks to add to this list. It's not as deep as I'd like it to be, but I have some great ideas. Sierra Wireless has got kicked in the in the junk. I think you buy this right now. IoT play, 5G play. Guy that I know who's a sales executive with a company that supplies healthcare and retirement community technology said that they use this stuff all the time. They sell this stuff. So, little $500 million company growing at big rates. And here's the kicker with Sierra Wireless. They're starting to add subscription revenue and recurring revenue. So go take a look at their current statement or their current presentation. You'll understand that. I think Sierra is still going to go back up into that 30 range. I think you're getting a bargain right here, these prices. Take a look at this company. I don't even know who this is. Oh, T2. All right, so people have been asking about T2. I warned about T2 on Monday. Why did I warn about T2? Because I read this guy's article. And these guys actually have a pretty good record as short sellers. And what have I said over the last year or two? It might become easier to be a short seller than a long investor for the next several years, or into the 2020s. But here's what you should read. It has to do with how sepsis is treated. 70 to 80% of sepsis cases are suspected. So even though they can't get the test result for a couple of days with the old testing mechanism, they start treating you with the antibiotics ahead of time anyway. Of the fungal-based sepsis infections, I don't know if that's the right word, the test could be faster, but again, unless they just have no suspicion of you having sepsis, the odds are they're treating you with the treatment anyway as a preemptive measure. So a lot of these hospitals, and the reason why the sales have been so slow is because these hospitals are like, it's $150,000, $150,000 piece of equipment. The tests all cost $200 a pop. We're already treating for it, and we're going to know in 2 days anyway because we have a cheaper way of doing this test. That's a big hurdle to get over. So somebody asked, why do I think they might only sell 150 or so units in the United States? Remember, they're projecting out 110 by 2020, and that'll be just enough to get them to even. The reason 150 is you take a look at the cities around the United States. How many Trauma 1 centers are there? Right? I know it's not a big number. In Milwaukee, 2 million people in the area, we have 1 level 1 trauma center. And you don't need every hospital to have various types of tests. They'll send you to the higher end hospitals. In a big city like Milwaukee, and granted it's not a big city, but it's still 2 million people in the general area, we've got 1 level 1 trauma, within like an hour or 2 hours. You gotta go out to Madison to get another one. That's over an hour away. So the market for them is, maybe the 100 biggest cities, your million+ cities that take in a whole area. So you're gonna have regional machines for this, and that's if nobody beats them. These guys cover the other technology that's out there and what other bigger players have tried to do, and they just haven't become profitable, or those lines of business haven't become profitable. Now, T2 Biosystems is a very small company. So what would it take for them to move the needle? A lot less in sales than, say, a bigger company. So, but even at 110, they're just breaking even. So what if the market globally is only 300, 400, 500 machines? These guys probably have to dilute because they don't have any money. And that means that the stock, these guys are projecting a stock price of, under $2. We're pretty much there. We're almost there, right? We're down to 252. It was four and change the other day. So I sold a bunch of I wrote covered calls. When I warned everybody about it, I gave my reasoning, and I got people saying, no. 4 or 5 people tell me, no. And look what happened. Why? Because the earnings came out today and they weren't very good. And when they drop that 110 machines, gets them to even, that should wake you up. Okay, what is really the size of this market? It's not 3,000 machines because every hospital is going to have one. There's going to be 1 or 2 machines per region. Milwaukee probably gets 1, probably at a hospital called Freighter. Madison maybe gets 1. Okay, that's 2 in the state of Wisconsin. New York, how many level 1 traumas? So don't look at the number of hospitals. Look at the number of level 1 traumas centers, and that's probably about the number that, that's probably the high end for these guys. So I'm not a big fan of T2, probably until they dilute. My guess is you can buy them under $1 at some point for a hot minute, and then if you want to speculate, go ahead and speculate. So with my services getting away from the speculative stuff, because it's just so hard to do this without being a specialist, I would say if you want to speculate at lower prices. I don't think you're scaling in right here. I think you're waiting for some sort of really horrible event. And this is bad, but these stocks drop 80-90% all the time. It happened to me with Exact Sciences, and then Exact Sciences went nuts because I loaded up at the bottom. You just got to wait. It's not every 5 or 10% that you add on to a position. It's more complex than that. All right, so where are we at? Economy, China lies. Alibaba's probably going to see some of the growth trajectory of Amazon. So I think you're looking for a spot to buy Alibaba. And remember, it's Chinese, so you always got to keep an eye on their governments. Are they going to, if there's ever a rumor that they're going to screw Alibaba, just sell. Be done with it. Norway's sovereign wealth fund looking at divesting oil and gas stocks. This has been out there for 7-8 months now. But they're going to get rid of the oil and gas services stocks and some of the pure drillers. It's going to trickle out. Remember, most of Norway's money, this is why they can afford socialism or something close to socialism, is they made all of their money, 80 to 90% of their money on oil. We're at the end of the oil and gas age. Are they going to be able to afford everything that they were able to afford once the oil money is gone? Right? They better find a replacement industry or something to replace it with. You know, everything's a function of money. And, you know, interestingly, these folks who want to have more social programs and more socialist approach, they don't look at where the money comes from. Interestingly, those people are all very pro-green, pro-climate change action, and I am too, but they don't realize where their money came from. Norway's sovereign wealth fund used to be called the oil fund, and now they're having to get away from that. And this is going to have repercussions on how they run their country as that money goes away. How strong is the fossil fuel divestment movement? This family called the Rockefellers have been selling their fossil fuel investments for the last several years. They got rid of all their Exxon. Yeah, not every member of the family, but the big hunks and the charity. So, you know, keep that in mind. This is a big deal. This is oil people telling you, the opportunity in oil is starting to go away. I talked about it in an article. Oil isn't for investing anymore. Oil is for trading. And you have to be a pretty good trader if you're going to do this. We're in the process of getting out of our oil investment stocks the next time we get a rally. And there will be a rally because some of these companies, the ones we're in, are just so profitable. I mean, their profitability is growing huge. So at some point that matters, the fact that they're just spitting out money. But this isn't going to go away, right? This isn't going to go away. It's got the support of people all over the world. And, you know, in the United States, the millennials don't really support the fossil fuel industry. So, you know, we just have to be aware of this. This is not a long-term investment anymore. And again, I've been an oil investor since the late 1990s when everybody told me, you know, it's different this time. Well, that's worked out up until the last couple of years. Exxon. I've told you that Exxon's got trouble. And everybody tells me I don't know what I'm talking about. Exxon and Chevron and most of the majors are going to have big problems in the 2020s because they're just not going to be able to exploit their assets as well as they want. Exxon, in particular, is going to start drilling a whole bunch in Guyana and also the Permian. And they're going to try to make a ton of money in this last leg of the oil age. And the problem they're going to run into is so is everybody else. So sometime in the 2020s, as that growth rate for the demand for oil continues to go down and down and down, and then eventually turns into a negative number, probably around 2030, give or take, and all these companies have ramped up their production because, oh my God, we got to get these assets out of the ground. And you're going to see oil get real cheap again, probably down in the 40s on a consistent basis, 40s and 50s on a consistent basis. Right now, we have in the short term a developing shortage of oil. However, once these new wells in Guyana and Brazil get off the ground, you know, and Saudi Arabia at some point is going to say, hey guys, be careful because we're just going to pump all of our oil. And, you know, why would Saudi Arabia leave any of their oil in the ground? They're the cheapest. So the cheapest player is going to pump all their oil eventually and wipe out everybody else. They should do it sooner than later. And I think that by 2021, they're doing it. You know, they are no big fans of President Trump. So I think that they want oil to be more expensive. And I think the Chinese, I think there's a lot of things lining up to try to get rid of Trump from around the world. So, you know, we'll see. We should keep an eye on that. And I'm just saying, I mean, it's a fact that people around the world don't like him. So, you know, if they can manipulate the situation next year so that the economy is just a little bit slower, you know, the stock market looks just a little bit worse, they might do it. And from Saudi Arabia, more expensive oil is good for them. So they'll do it. They want to take care of themselves. They're not going to do President Trump any favors. But then once he's gone, you could see them just say, okay, we're going to pump all the oil we can. Crash the price of oil again. you know, instead of taking $80 a barrel, which is on their old budget what they needed, you know, maybe they revise their spending. You know, at some point they just have to say, you know, we can't skim as much as we skimmed. We have to change the way the system works. MBS, for being a brute, is, you know, trying to do that. I'm sure he's corrupt just like all of them, but the price of oil at some point is going to come down. And even though I ripped on Tony Seba for saying oil would be, you know, $25 a barrel by 2023 or 2024, it was one of these years, you know, his scenario is starting to play out. So look up Tony Seba, adjust the time frame a little bit, but, you know, it's looking like that. So we have to be careful on oil. We need to be selling the rallies, not buying the dips. Exxon is going to get crushed, and they're going to have to split their company up at some point, and you're going to want to be in the parts of the company that don't get loaded with the debt. My guess that the pipeline companies that they spin off are probably going to be pretty good, because eventually we're going to need those pipelines for water. All right, so Exxon done. And interesting article here by Beth. Algorithms are not biased, data is biased. I just was saying that to somebody, that people have a conclusion and then they fit their data to it. Algorithms aren't fooled by that. So you have to make sure that your data is good. So, you know, I would read this article. It's pretty interesting. Other than that, I think that's all I got for today. Somebody commented Saudi oil costs $4 a barrel to produce. That's not really true, but it is the cheapest out there. People always put these real low numbers for the break even on oil, and yeah, that's the marginal break even. But you got to remember all the sunken costs, right? Oil's only profitable in the United States at $40 a barrel or $45 a barrel once all the sunken costs are paid off. So keep that in mind. You know, that it takes a long time to get out there. Water plays, I don't know what my favorite water play is, but that's definitely on the radar. So, all right, everybody have a great weekend. We've successfully been keeping these under an hour again. Antero Resources. I just bought some this week. Natural gas has got a pretty good future, at least for the next couple decades. And some of these are just so oversold that, again, once the divestiture people have divested, and that's actually largely, you know, kind of happened already. Over 1,000 institutions have divested. So these littler companies, they've already lost the people who were going to divest. And Antero, as I've talked about, Antero was one of those rare situations where you had a big insider cash out, 3 big insiders cash out, and that created just one of these short-term events. So right now the technicals still look bad, but the fundamentals of the company look pretty darn good. You know, they're in the right spot, serving the right people. You know, they have pipeline access all of a sudden out there in the Utica and Marcellus area, you know, Pennsylvania and whatnot. They're going to have a big rally. I would suspect that, you know, I mean, that bottom fishing price was clearly wrong, right? But this is way too cheap. You know, I think it can rally all the way back up to 18 for sure. And can it go into the 20s and 30s over the next several years? I think this is probably one of the easier plays out there. Study the company. Stop looking at the price as a function of how good the company is. That's just a sentiment of the market. That's just the money flows. There's an unusual money flow event. People are still, you know, butthurt about it. This is an opportunity. Antero's a big opportunity, in my opinion. I think Centennial Resources is a big opportunity. A lot of these oil companies, they've already lost their people have already divested. So as they become profitable and they start increasing dividends, they start increasing buybacks, the ratios look phenomenal. You'll get big money that matters that pours back into it. And I think a lot of these companies are really going to get taken private. You know, if they're spitting out that much cash, you know, why wouldn't somebody come in there and say, okay, well, hey, Antero, you know, I'm worth, you know, me and my group of investors are worth $10 billion. How about we buy half of the company? Right? And let's take it private with, you know, borrow the other half. Why wouldn't some of these companies, especially the ones under 10 billion, wrong industry. Why wouldn't companies like even Chesapeake, but why wouldn't Antero and Centennial and Chesapeake and some of the other companies I've talked about, so some of these sub $10 billion companies, why wouldn't they get taken private or bought out? It's going to happen. So I love selling puts on most of these. And it's just a function of time. They're spitting out so much cash. Take a look at their financials. You know, how do these companies keep spitting out so much cash? Because they've learned how to be super profitable. IaaS. I've shown this chart last couple times. Let's modify the equity universe. Sectors, energy, just all of them, make it easy. Look at all of these energy companies spitting out cash. They're buying back shares. Some of them are paying dividends now. Dividend growth. I mean, those are pretty good dividend growth numbers. The ones that are paying dividends. They're reducing their debt. You know, oops, I didn't mean to do that, but yeah, let's see. I'll probably give something interesting. So if a company's buying back shares, paying a dividend, and reducing debt, what's going on? They're making money. At some point, it's attractive to investors. Chevron of the majors, at least, is in the best shape at the moment. I think Total is internationally the one. But look, who are we invested in? We're invested in Devon Energy. Talked about Hess, Pioneer, EOG, Concho, right? Those are all in the article last week or the week before. Parsley Energy. So they're all moving in the right direction. And Kana's not on here only because of the merger. They'll be back on here in a quarter or two. So this is a chance to buy in Kana super cheap. You know, chance buying Kana super cheap. So again, the divestiture for the little companies has pretty much already happened. But the big companies, the Exxons, Chevrons of the world, they haven't had their major divestitures yet. They're coming, right? The headline I showed you out of Norway, it's coming. When? I don't know, but it's coming. All right. Let's call it a day. Have a great weekend. I like most of those dirty dozen on oil stocks. Yeah, just keep scaling in. Look for the big moves. When do I think Calyx will move? You know, when sentiment gets a little bit better. There's one thing to keep in mind. There are trillions of dollars on the sidelines. Big rotations from bonds into stocks are coming because interest rates are going to be low again. So they'll rotate. The central banks, European, let's finish with this. The central banks, and I'll have David Modell on eventually. But the central banks are all softening up. European Central Bank just did it. The Fed's already talking about it. Next week, you know, we'll talk about central banks a little bit. I'll write an article hopefully in the next week, but I'm going to be traveling, so maybe not. The Federal Reserve is probably going to pause, not end. I think they're going to pause their quantitative tightening, or at least tap the brakes on it, not take as much money out of the economy. So keep an eye on that. If the central bank, if the Federal Reserve all of a sudden gets outright dovish again, kitty bar the door, we get a big rally, right? So keep an eye on that. All right, have a great weekend, folks.